Tonight is our 2020 ER series, presented by Cheddar Flow, a modern options order flow platform. Track and monitor option activity that helps you uncover institutional money flow, all in real time.
Alright, heading into part 2 of our week 3 of this ER series that's going on. It's another midweek video, and midweek videos always call for midweek drinks. Luckily, we got to one of my favorite breweries this past weekend and picked up a bunch from Decadent Ales. So I got a nice little pint right here next to me of a Pineapple Whip IPA. Super great. I think it's like huge in, the ABV volume, so I don't want to be hit with like it's too fruity of a drink to just move on and go from there. It's super delicious, and if you've never heard of Decadent Ales, this is not a promotion, so don't worry about it. But that is one of the best breweries I think I've ever been to in the flavor and just the pure amount of alcohol that is actually in those things while still maintaining the flavor. So make sure you check out Decadent Ales. You can find them. It's great. Tonight we got 5 plays. Of course, there is a ton other that are going on this week. We're hitting Amazon, Visa, Coca-Cola, Hershey, and Caterpillar. There's a bunch, and we're just taking over from Thursday to Friday. There's obviously UPS, there's Verizon out there that we could be playing. AMZN we could be doing. I think X is out there, Steel. And then you have, the whole oil industry that's basically going on Friday with ExxonMobil, Phillips, all those things. Charter's out there too. I know that's another big one, Honeywell. But I wanted to narrow it down. I didn't want the videos to be too long. So again, if you're just joining us and you're new to this that's going on, we're not going to be talking out fancy terms and trying to make you confused. We want everything to be plain and simple, so you can follow along, and this is meant to spark your interest to learn more. This is not meant to just tell you what's going on. So everything we've broken down to the bare essentials of what each play is meaning, what we're thinking of it, how we go about finding those things. So make sure you're understanding that. And if you're looking at this and like this is elementary level, well, it's good sometimes. You need that elementary level to kind of make sure that someone knows it and understands it, and also like pass this on, teach people how to learn options. Like, it's one of the things that people just go IOT calls and puts, and that's what they think options are, while it's just a great vessel for hedging your long-term or your portfolio positions that you have, long-term positions, just in just learning how to take high probability trade. So let's dive into that real quick, and let's jump right into Amazon. Amazon is the first one that we got going up. It's going to be the big one that everybody wants to play. And the first thing you're going to first notice about this is the implied move on this is about $200. All right, so we're trading at 1853. So it can pop up. I think the actual thing on it is 70. But you know what? You just do it because give it that extra 100 layer to each side. So a 1950 to down to 1750. And that's your implied move that you probably want to work off from, and you kind of want to judge, okay, I want something that plays into this. I don't want anything that exceeds that, and hopefully it hits. And so another thing you can do is learning about IV percentiles, and trying to judge what type of plays you can come up with. And so when you pull up the IV percentile that's on Amazon here, we're sitting at 45%. So there's a chart little thing that I throw up, a little thing you can follow along on that. These are not for sure things that you should do 100% and deviating away from these norms. It just tells you what type of environment you're looking for to put on certain spreads. And so at 40, in that 0 to 50th percentile, you're looking for debit spreads, calendar spreads, ratio spreads, and diagonals. All right, so learning those things, you can look back through some videos where we kind of break them down and what those are. But those are the types of things that you want to do in those types of environments. So this all plays within that move itself. And like always, being a seller of premium means that you typically are going to win more than you are when you're a buyer. It's just simply, it's the sucker's bet that's out there. All right. So you'll see that almost everything we do is these iron condors, these butterflies, these calendar spreads, and you're typically aren't going full biased with these debit vert spreads that are out there, and you're not doing strangles and straddles for each thing because you need higher environments of volatility in order to make sure that those are successful. So you don't want to just you don't want to just make sure that you're narrowed to these positions. You want to know why you're playing each position accordingly. So when we toss up this next play for Amazon, the iron condor that we have, we're talking about we want to make that no matter what happens in between that implied move, we're making a set amount off that. So when you look at this, and the play itself is you're taking a 1960 call, you're going to be selling that, you're going to be buying a 1965 call as well. So you're selling that, meaning that you don't want it to go above 1960 because you're going to collect all that premium, but you're buying a little bit of protection to make sure that it's not just open exposure in case it goes above 1960. So you're capping that with that 1965. All right. Then you're going to jump down to complete the other end of the iron condor to make sure that it looks like a bird when you're a kid and you're drawing those V's, that whatever. It's kind of like what it looks like if you never looked at one. And there's always going to be a picture on the videos for you to follow along as well. And so on the other end, you're going to be selling the 1775. And then you're going to be buying the 1770 for protection as well. So anything between those levels. And when you're looking up on there and you actually pull it up, all right, so you're going to be making money as long as it stays above 1773, all right, and as long as it's below 1760. And if it does that, then you're going to be making $140 off that. All right, so no matter what it does, you don't care if Amazon beats, you don't care if it stalls, you don't care if it drops. You just want to make sure that it doesn't just drop into oblivion or rocket to the moon. All right. And if it does one of those things, that's okay, because look at, you gave yourself a 200-point range for Amazon to do whatever it wants with. It's higher probability of it happening. All right. So when you put on that, and your max loss is at 360. All right. So at that mark where we set up our protection levels at with the buying sides of that, if it dropped down to 1770 and below, that's when you lose your 360. If it pops up above 1965, you're losing that 360. But you're not looking at it when you're doing these plays. You're looking to collect. It means that you're going to put yourself at greater risk of exposure of bigger downsides because of what you're doing to pin it and trap it in that location itself. So that's our play for Amazon that we have. I honestly, I don't think you should be looking at verts here. I don't, because it's too directionally biased. There's a lot of things that are going on in the market in general, just with the virus that's out there, with EU trade that's going on. You have China with their markets going crazy. So trying to play the environment that is the market itself and the earnings, and trying to put your own bias in there of just strictly one directional of, if you bought a call vert, you just need it to go up. And if it doesn't go up, you're screwed. So find a different way to do that. And all the other plays of buying a straddle, strangle, you're selling credit spreads, that can also be very dangerous if it's not tight. But you're also have to kind of gauge to yourself, you're looking at easily over times 4 loss of whatever you're getting back on those credit spreads, credit vert spreads on those, meaning you're collecting and hoping that it just stays below certain things. Those are the types of things that you want to make sure that you're not going too crazy with this happening. So that's why I think the Iron Condor is the best thing to run here on this one. And just the overall price of that you're going to be paying for these spreads, and it's Amazon. All these things are like $20 per, if you just gave yourself open exposure. And if you have a bias, sure, go ahead and do that, and just make your money while I'm capped and you're laughing while you make thousands off that. That's okay. That's going to be okay. I gave myself a 200-point range where Amazon can do whatever it wants within there, and I'll make money. So I'm happy with that. The next one is going to be V, which is going to be Visa, the credit cards that are out there. First thing you're going to notice is the run-up that it had. Super run-up, super fast. And you say that chart technicals don't matter in ER. You're right, they don't. It doesn't mean anything. The best thing you can do when you're in these types of situations where there's giant run-ups is look for historical support, because you can build plays off of that and hope that that's where investors or all these large monies will be throwing money at to make sure that's maintained at that level, or to make sure that's their selling point. So you have to kind of play into that as well. So when it's sitting at 202 currently. We'll call it 203 since it's more closer there, at a $6 implied move. So 209, and then $6 back is going to be 197 off that. So that's going to be your implied move and what you're trying to play within. And if it goes beyond that, that's okay, because the implied move is that's no one really expected that, and only people that took bets were probably a little bit gambling, or what if you want to go in conspiracy theories, they know somebody. So when you look at these things, the play that I came up with that I thought would be fitting for this is looking at it is going to be a 202 call, a 207.5 call as well, and a 212.5 call. You're going to be looking at roughly, I want to say 116 on this. Yeah, 116 debit that you're going to be paying for this. It allows for a little bit of downside. All right, so but right now it has to go up, but it's pinning it in that. All right, so the reason why I have that is when you get these giant run-ups, it's typically not giant crashes as well. Usually some people wait for support, and that's where they kind of want to play into it a little bit, and that's where they want to pick it up. I wait for the pullback, and that's when I'm going to get in. So when I see this played, that's what I'm kind of looking at and what I want to happen. It is $116 to make sure a pinning play, but you're getting a range of 204 all the way up to 212 on that. I think that's going to be fine. It's going to play right into the implied move. It's not going to be much downside, but it's going to give you a stall, and it's going to give you a pop. That's 2 out of the 3 things it could possibly do. It's not 60 cents or 66 probability on that, so don't see it that way. But that's the play that we have for Visa going forward. The next one is going to be Coca-Cola, part of the consumer staples group that's out there. A lot of the names are going to be reporting later too on that. So kind of look at the overall sector of what a few other names are doing, how the consumers are doing overall. Does it play in there? Like McDonald's would be a good one to kind of consider. If McDonald's is doing well, typically Coca-Cola is going to be probably seeing a similar thing, because both play into what consumers want to go out and buy. They're both that junk food. They're both the just it's a stupid way to view it, but that's how you do it, and how you just consider it overall. So when you're going into and you're looking at the trade itself, again, finding the implied move, we'll call it at 150, $1.50 move, and it's trading at 57. So it's going to be 58.50 to the upside, and then it's going to be 55.50 to the downside, which 55.50 leads right into that historical support zone. So that's, if it pulled all the way back there, you have to think maybe it's going to stall there or pick up support there, but it also leaves room to the upside. So when you do that and you consider that type of play, and you go back and again you check the IV percentile of this at 53%, so you have 2 different options to choose from. You have credit spreads, you have iron condors, broken wing butterflies, then debit spreads, calendar spreads, ratio spreads, diagonals, all to play with and kind of consider. What I chose here, again, like always with this whole run up in week, is that I have calendar spreads and I have diagonals that are put on here because I want to take advantage of current market conditions that are trying to break above but could be risky to the downside. So you're going to be selling whatever thing you're going to be doing for this week, whether it be a put or call for when putting on this calendar, and then you're going to be buying the next week for protection, but also to play into it if you manage it appropriately. So when the play that we came up with for this is going to be just a simple 57 put calendar. So when you think about a put calendar on here, you're selling a 57 put this week, meaning you want it to go up. All right. You want it to go up to at least 57.01, and you want that to close there on Friday. If it does that, you've just collected that entire premium that was attached to that 57 put. All right. And then you have next week's put there to worry about. So if market conditions are still going crazy, euphoric run up, and now you're entering a new week with a possible like at the money play or near at the money to the opposite side, where the market could finally actually have that pullback. Now you're exposed to that, and you could now play it back to the downside and collect whatever you can get off that put as well. So the main thing here is trying to get that first week nailed, where you're collecting that premium off this week, and then looking on how to manage it accordingly going into next week, or just cutting it off by Friday as well. It's going to run you $10 to put on that that put calendar. You're going to have a max about probably 50, I want to say, if I'm looking at that right. And then you're going to be exposed to 50, or it's probably going to be about 55, 30, and then probably about 58, 70, I want to say. I'm not looking at the thing up there. I'm just kind of trying to do this in my head. But you'll have the pictures up there to kind of work from, and you can just line them up accordingly and do whatever. So not much downside either. You only paid $10 for it. $10 are going to go down, and you could potentially get 5 times your what you put in back on that if you played accordingly or more. So I think that's going to be a great play. And I thought about, you can't run iron condors on here. I mean, you can, but you're not going to be collecting much. It's not worth it. You'll probably be walking away with like $25 to $30 max for whatever iron condor, and that's per contract, on whatever you can come up with to fit that. You can be directionally biased and grab puts here, and and say whatever, it's cheap enough, I'll get it, play it. But that leaves you only to that. It has to hit that, and you have to worry about Ivy Crush on this, and if there is any that's going to be playing into this, and depending on what type of move it makes. And you're definitely not buying strangles or straddles with here, because it's not going to make a big move. It's not going to be worth it to put that on. And the other thing that I thought about is potentially doing broken wing butterflies as well. And you'll see that I do that a lot is when it comes to these, because I want the stalling aspect of it involved, and I want to play into my bias of what I think it could do as well. So if it goes completely against a stalling or my bias, then I tend to lose a little bit more on that. Like, I think I have a SBUX play out there that could hurt if I run into expiration with that and not untouched and not managed, because I expected SBUX to stall right there at that 88 level mark and then pop up from there. So giving yourself the best probability to hit these trades, all based off of what they actually do by buying and selling certain premiums, and not just like, oh, my friend's got some insider information on to do this, and so I'm going to go all in calls. All right. So the next play we have after Coca-Cola is Hershey. All right, and it's not the most liquid thing that you could possibly play, unfortunately, and that's what kind of sucks about Hershey. When you pull this up, you have the $6 implied move trading at 152. You have, we'll just put it at 160. All right, because 160 is near all-time highs, and if it gets up there, it should be playing towards that as well. And then you have the downside -6 off of 152 at 146, which is right near the 50-day and the 200-day. So you have to think, if this is going to continue, investors are going to be looking at that to be a pickup point or a selling point for them as well. So using that historical support to play into whatever position you come into. What I came up with, again, I'm going to be, since it's difficult to get in and out with limited liquidity. It's hard to put these plays on and run them efficiently. So you have to be careful and conscious of that as well. But running this iron condor on here, by getting the 157.5 call, you're going to be selling that, meaning that you want it to travel and stay below that, and buying the 160 for protection on that condor. And you're going to be selling the 144 put, and then you're going to be buying the 142 put on that as well. You'll be collecting 68 on this. You'll notice that there'll be a wide spread if liquidity sucks on this, so it may not actually be 68, but you'll know exactly what you're getting back, because it's a credit spread. All right, so if the higher you bid, the less likely you are to be filled for credit, or for these credit spreads, because people want to collect as much as possible. So the lower you go, the easier you'll be able to get filled. So put in that consideration and how to work it. But it's another pinning strategy. The other one I came up with, if you wanted to do this, is running a credit vert call, like a call credit vert on this. All right, so 157 you're selling, just like the top of the condor, and then you're buying the 162.5. So this is a bullish bearish perspective, where if they come out and they hit on numbers and it spikes up a little bit, I just don't think it'll spike up a lot. So that's why I'm selling into that. All right. And then I expect it to go down. So I want to collect everything I can from that 157. So I don't care if it finishes at 157.49. I just want to collect everything I can from that. And I'm using the 162 as protection as well. And you could, you can actively manage this as well. And you could buy that back if all of a sudden this goes against you, if you actually could, and then just run with the 162 moving forward. It's ambitious, but I don't think you should do it, just because I don't think the move is fitting, because, you know, it's a $6 move and you're playing off of nearly a double that essentially in order to make money off that call. So not good for in terms of that, but great in terms of you're completely almost unbiased now, but you just don't think it's going to pop really hard and it'll do anything else and you don't care. And you make 75 off of that. The downside of all these things when you dive into credit spreads is there's huge downside for what you're trying to do, because you're trying to collect off these people. All right, so 75 you make off this, but 425 is the max loss that you get at 162. Again, but what are the chances that it hits 162? Is that worth it? You know, like if you're looking at Coca-Cola and, you know, your maximum downside you could possibly lose is at 70, well, you know damn well Coca-Cola is not going to hit 70 off earnings. So why not use that as protection and guidance? So realistically, even if this completes its move all the way up, even at 160, it hits off of this play and it just goes crazy because its sales are amazing, and it hits 160, you're losing at about 150 on that as well. So not too much in terms of, you know, you're still risking 2, and you can have a stop on there and just moving forward from that play. But I think those are the 2 best plays that you can possibly have for Hershey out there, is running that iron condor and a call credit spread to gather that money. The last play that we have is going to be Caterpillar, which is going to be our broken wing butterfly. And these are the things that I'm telling you about with it comes to give me a stall, give me a bias in either direction, and let me take the hit on any downside risk or upside risk on my viewpoint. And then again, looking into the implied move of $6 that can come from that, you're at a 70 IV percentile, which is high. So in 70 to 100 percentiles, you're typically running straddles, strangles, iron butterflies, and you're looking into credit spreads. You're looking into iron condors and broken wing butterflies, and you're not being a buyer of premium when it comes to debit spreads, calendar spreads, ratio spreads, and diagonals, because it's just probably going to blast through those things, and it's just not a good environment for those types of plays. All right, so in that 70th percentile, you have to pull up your chart. And where is it near right now? It's at the 200-day, nearly there. All right, so try to use that as base, as investors may look to find that to be a support level, and you can try to run off a previous history of support being there. So when you run through that, so you're looking at 200 days at 133, we'll just call it that, and then it's had this massive fall down just due to overall, you know, the exposure to China, I'm sure, and just everything that's going along with all the headlines that are out there. So why not use that 200-day as a base for your play? And so when you throw this up and you're looking at this broken wing butterfly that's on here, and you're saying right there at that 200-day, if it dips below that, that's when I start losing money on my play. But if it stalls out right at the 200-day because investors are really battling to maintain that, then you're making 150 off that. And now let's say, oh my God, it did really well. There was no excuse for it to be near the 200-day. The broken wing aspect of that allows you to make $58 the second it goes over 136 and above, and you don't need to worry about it anymore. That's how much you make. Downside is if it loses that 200-day, you're losing 142. But that's what you get for adding that protection and that setup on your broken wing butterfly, so that you're always making money if it goes up or it stalls. You have to give up something in order to. It can't just be great in butterflies on both sides and, you know, just work out perfect in your favor. It needs something to balance it. The universe has to be balanced here. So those are all the plays that we have. We have Amazon, Visa, Coca-Cola, Hershey, Caterpillar. Obviously there's a bunch more that we could possibly do, but I want to try to keep this as quick and as possible. This has been like one of the hardest weeks because there's just so many plays, and you know, if you ran every single play on here, like, you probably had a lot of capital to work with, and we're probably talking 5 figures easily in order to put on every single play just with the collateral that would be needed to run most of them. So pick and choose ones you like, and if you like the idea of some of these plays but you don't like where they're at, just adjust them down a little bit. But hopefully I sparked a little bit of interest, a little bit of bias onto, you know, like how we can make money with high probability or trades that work in our favor, that you just don't care what happens as long as it does XYZ or gives me something above a 50% chance of nailing this trade though. All right, so we'll be closing out this week with this video. We still have last week's video playing out with a few of those plays as well. And then we're looking to see who's reporting next week, because honestly, after this week, I don't know who the heck could possibly be reporting. And we'll go from there. All right, everyone? And we'll see you next week.